Hello and welcome to FinTech Insider Spotlight. My name is David Brear. I'm the CEO at 11FS. In this show, we shine a bit of a spotlight on the best and the brightest in the industry to really get an understanding of what it is that's chartered their career to get them to the level that they have done, and the period of time that they've been involved in the industry, what really has changed over that time. On today's Spotlight, we've got Bill Winters, who is the Group CEO here at Standard Chartered. We're going to be learning a little bit more about his career, his background, and really where he sees the industry going. So Bill, thank you so much for joining us. It's fantastic to have you on the show. We've talked a lot in the past. I feel like this is really like getting a conversation that we've had 10 times before, but in front of a camera. So I know you know the answer to all of these questions already, which is going to be really interesting. But as we said, we're going to talk a little bit about your career. But I mean, you've been CEO here for 8 years now. I mean, you've seen the industry really change dramatically. Tell us a little bit about that.
Yeah, well, look, I'm in the 8th year of my 3-year plan. And of course, things have changed quite a bit along the way, if you know, things like wars and pandemics and geopolitical tensions. But the industry is continuing to change a lot. I've been in banking with one 6-year period of interruption when I did some private credit and other things. But certainly post-financial crisis, the step up in not just the level of regulation, but the nature of regulation has been dramatic. And it's had very profound consequences for how banks organize themselves and operate. And how the rest of the financial system organizes itself and operates around banks, or alongside banks, or into the face of banks. And I think that's probably going to go through another round of changes on the back of the Credit Suisse demise and the U.S. regional banks and all that. So I think we can expect a prolonged period of change in the financial system. And as we sit here at the moment, the financial system feels slightly tenuous, right? Which is not to say that I think that there's some big break that's about to happen. I don't. But just that the things that we took as truisms for a long time are being challenged, fundamentally, and it has led to the collapse of very well-known banks. So the way that the private sector investors react to that, the way that entrepreneurial capital reacts to that, and the way that, of course, regulators react to that, I think is not yet very clear in the minds of each of those stakeholders.
Well, and it's interesting. I mean, obviously, your role as Group CEO. I mean, and for anybody watching this or listening to this who doesn't know, I mean, Standard Chartered, you guys operate in lots of the world. Actually dealing with that, regulatory sort of pressures in different climates and different geos. I mean, everybody's got a different book, right? So it's that must be quite a fascinating thing to do as well.
That's fascinating. It's what attracted me here in the first place. Standard Chartered it's a fabulous bank. It's been around for 170 years. It's a UK bank. It was commissioned under royal charter by Queen Victoria, kind of to finance the empire, as it were, and to finance trade in the empire. Originally, it was the Standard Bank of Africa and the Charter Bank of India, China, and Australia, which came together in 1969 to create Standard Chartered Bank. But as we sit here today, we're operating we're involved in 120 countries around the world. We have on-the-ground presence in 55 or something like that. And we're operating in both retail and wholesale markets, very much concentrated in Asia, Middle East, and Africa, but obviously with the headquarters here in London and a very large business in the US, clearing US dollars, in addition to serving US clients, typically in Asia, the Middle East, and Africa. So we're in the world's most dynamic markets today, with a good, strong foothold in Europe and in the Americas, which are obviously much more established. And it's a fascinating place to be involved with, but very local, and across sub-Saharan Africa, Northern Africa, everywhere in the Middle East, everywhere in ASEAN, everywhere in South Asia, everywhere in East Asia. To be on the ground, local, and be considered a local bank is a fascinating experience for me, and it gives us a real edge in a lot of ways. Of course, gives us a lot of challenges as well.
Yeah, it's the sort of pressures of. I mean, a lot of organisations try to standardise things across the world in that way. But what I've always find impressive with you guys, like you say, the kind of local presence is everybody. I've been lucky enough to do things like jobs to be done frameworks in different places. How people interact with financial services in Hong Kong are really different to Moorgate. So it's like that learning is an amazing thing, isn't it?
I mean, it's. I think a key imperative for us is to understand the local markets in which we operate, but at the same time to do it in a way that's not so customized that we lose any benefits of scale. And so we're in the process now of converging onto a single core banking system, for example. And that sounds obvious. It's very hard to do. We're about 2/3 of the way through it. We migrated 2/3 of our markets. It will have a single mobile banking app. Of course, it's going to be completely customized for the local market. There'd be different products, different language, different regulation, and a different franchise for Standard Chartered. But the backbone has to be the same. If it's not, then unless you're just a huge global bank, which we're not, we're a mid-sized global bank, you can't do it economically. So that challenge of remaining very local, responding to local customer needs and idiosyncrasies, but having a global level of scale in your underlying infrastructure and controls and risk management systems and governance, blah blah blah. It's a fascinating challenge, and I think we're doing okay. We're doing okay.
Well, you touched on regulation, and technology there, but obviously the shift from a technological perspective over the last 8 years has been pretty amazing as well. It's an amazing point in that cycle to see the predominant channels of engagement with your customers is through digital channels, right?
That's right.
And even in the most extreme circumstances, people kind of reach for their mobile phone as the first port of call.
That's right.
I mean, that's an interesting challenge, isn't it, in terms of a brand that wants to engage with people from a local perspective. Doing that digitally is quite difficult.
I suppose, it's as difficult as anything that we have to do, but it's not, the trend is so clear. The real question is how quickly are customers prepared to go? How quickly are customers willing to separate themselves from human interaction in some of their banking services? And certainly when we get into the mass market, that will be entirely digital.
Yeah.
And it is for us. We've reduced the number of branches that we have from something like 1,600 to something like 400 today. And that will continue to attrite. It will not go to zero, right? It definitely won't go to zero because even at the mass market, there's tremendous value, both branding but also customer service value, and not just to the people that haven't gone digitally native themselves, but to others who, from time to time, want to have some interaction. When you get to the more affluent end of the spectrum, where people are managing their money, they're managing their savings, they're perhaps taking a larger mortgage. Certainly, when it comes to investing for their retirement. Or thinking about how they're going to manage their late in life healthcare requirements in the context of the management of their financial resources. That is going to be a human business for a long time. And there will be some generative AI that can give excellent recommendations for what you should be doing with your money. But there's still, I think for a long time, going to be a desire to sit like we're sitting right now, have a conversation, say, look, I'm thinking about this. Does that make sense to you?
Yeah.
And of course, the relationship manager or the advisor is going to be informed by technology to a greater and greater and greater degree. But I don't think we'll lose that human element for quite some time. So finding the way to pace that conversion from the pure human touch model to a pure digital or digitally analytically driven model.
Yeah.
That's the hard part. But the direction of travel is perfectly clear.
Yeah.
And if you don't have a holistic set of digital capabilities, you're not going to survive in this business.
Yeah, it's an interesting distinction, isn't it? And actually, I guess digital has sort of shifted everybody really to more generic experiences. Everybody logs on, everybody gets the same experience. But to your point, actually, the sort of empathy of a human is a critical part in being understood or feeling like the organization is kind of on your side. So, that's going to be a fascinating journey ahead of us to kind of do that. But, everything we're talking about is, whether it's regulatory, whether it's technological, there's sort of innovations in the market. And obviously, heavily regulated industries, are not usually famed for innovation in that space. But tell me a little bit about how you think about that, because, you can't stand still. You've got to keep moving forward.
Yeah, we do, and that's not straightforward at all. There's a lot of, I would say, external inputs into a process of running a heavily regulated bank, and banks are heavily regulated. And I'm on the board of a drug company, a pharmaceutical company, also heavily regulated. Obviously, those are matters of life and death. You don't feel the level of involvement from the regulatory community into the business to anywhere near the extent that you do in a bank.
Wow.
And that stifles innovation, for sure. There's a lot of reasons not to do anything that's different than what you did yesterday. There's a lot of reasons to do something very different, starting with the fact that there are non-banks who would love to take the profitable parts of our business, and they're going to be extremely innovative in terms of how they deliver that. We've obviously seen quite a bit of that, most obviously in the payment space, but we'll see it in wealth advice and everything else that we do. The flip side of that is that the culture of compliance, the understanding what it means to track money laundering or to introduce sanctions, which unfortunately are a feature of modern life. These are things that banks have become really good at.
Yeah.
We've invested very heavily in the compliance regime. We're very good at it. And while big parts of the non-bank sector have been able to either escape entirely the reviews that come from various law enforcement authorities or whatever, when they get big enough, or when the criminals figure that these are exploitable channels, the full wrath of governments come in, and it's not surprising to me that we're having a relatively good time in our digital asset businesses, for example. So these are innovative ventures in the sense that we incubated them in a separate lab. We brought in third party, either started with third party partners or brought them in, and tried as best we could to replicate, and I think quite successfully, to replicate the culture of innovation that you might find in a VC-funded set of ventures in digital assets. And we were doing well before the crypto winter and FTX collapse and all that. But when it's become clear just how off the piste some of the original pioneers in that industry were, the attractiveness, certainly to institutional customers, but I think increasingly to retail as well, of a bank sponsored, kind of by definition compliant sort of business model allows us to take what was, I think, very good innovation combined with a core pillar of our strength and turn that into a very special business. And I think we'll see those sorts of things in any areas where regulation and compliance becomes very important. But there are lots of things where regulation and compliance aren't important. And how do we innovate in those areas? It's a tricky balance. I think we've done quite well with our SC Ventures subunit. It's separate from the bank. We report it separately. It's separately funded, but it's still part of Standard Chartered Bank. And whether it's creating digital banks in Hong Kong or Singapore, which you helped on, or creating an SME platform in India that is it's got 800,000 customers. They're incubated separately, but with all the leverage and the benefits that come from being a regulated bank that understands compliance and understands regulation and also understands customers and understands credit and understands booking models and transaction processing, and we can drag and drop where appropriate parts of Standard Chartered's infrastructure into these things, but always with the entrepreneurs or the innovators able to optimize around what's best for their venture, and not what's best for Standard Chartered Bank in the short term.
I mean, it's an interesting balance, that, isn't it? The sort of risk, like you say, 170-year-old organization. You've got a lot more to lose than a 6-month-old fintech in that sense. So balancing risk and innovation. We actually on the show we actually had a guy called Smart Woolport, who the UK government brought in to. He was a chief medical officer for the UK government for a long time, to come in and advise on actually how you innovate without killing everybody, basically, as you say.
Yeah.
And it's a fascinating one in terms of like the risk models to go through. As you say, you're 170 years old. You've scaled the organisation to a great, not you personally, obviously, the organisation. You've scaled the organisation globally. I mean, getting the balancing act of continually innovating, continually evolving the structure, the technology, the risk, and actually culture in that. I mean, that's a difficult thing, isn't it?
It is, but the parallel you drew to the life sciences industry is kind of relevant. And in the pharma sector, a scientist develops an idea, a proof of concept, and it hasn't touched a human being, but you've got to decide how do you construct a set of trials. First in a lab, then in animals or in a test tube or whatever, and then eventually in humans. And it's a very well-established process. It's not perfect. I mean, there have been bad outcomes, as we know, but many more good outcomes where we've ended up with life-saving drugs that have changed the nature of healthcare. And but it's a system of very rigorous analysis and testing and failing and learning and then retesting and failing and learning, and obviously trying to cut off the failures before you do real damage. And It's not that different in the innovation sphere. And I guess if you look in the way venture capital firms operate, high mortality rate, but it doesn't mean when they've terminated a venture that they don't focus on the underlying use case any longer. They just try to find a different way to do it, either with the same people or with a new group. And that's the approach that we've taken as well. So we have a reasonably high mortality rate. For example, we have an intrapreneur program where anybody in the bank can come up with an idea. And at the earliest stage, it's a competitive process. We funded several ventures at the back end of this that have now achieved substantial funding and are operating businesses. But we had 2,500 submissions. And that's a big funnel that's come down to, I think, 12 substantially funded ventures at this point, substantially being more than several $1 million. And which in this space, these are meaningful investments. So lots of mortality along the way. Some were never good ideas and never got off the ground. Interesting, but just didn't make it. Some, it looked like there was something there, and we played it out. And either the founders lost the will to push it forward, or we lost the will to fund it.
Yeah.
And some have been spun out because there were better owners of this idea, or in some cases they took the idea out, having been incubated a bit here, and then just did it themselves with our blessing.
Yeah.
So that's. It's not as rigorous, I can tell you, as the clinical trial process in pharmaceutical development, but it's the same idea. And the key to me is to create a supportive, innovative culture that encourages people to really throw themselves at this, because they're committing a huge amount of their time and then our money. To be supportive, but also be quite deliberate about what we're really going to back, and what we're going to step away from. And we'll be fine-tuning that forever, I think. I don't think we'll ever get it right, per se.
So Mark made the point that, the drug industry, nobody takes a drug for no reason. So there's obviously a massive connection between the production of a product and the problem that it's really trying to solve for people. Again, I guess as a global organization, understanding those problems is really the key to solving them, I guess. Yeah,
I know it's an overused term, but really understanding the use case is, and what problem are you trying to solve? SOLV is the name of our venture in India that is this SME platform, and we have a big local corporation banking platform in India, but we really weren't financing the micro SMEs, sole proprietorships, mobile phone dealerships. That wasn't a big part of what we did, but we were close enough to it to see just how underserved that client population was. They were underserved by the big Indian banks. They were underserved by us. And we thought that there was a better way to do this. So having identified the problem, we created a venture. It's called SOLV. And SOLV it's a B2B platform for small SMEs. At the outset, we got a couple of the suppliers into many of those SMEs. Initially, it was Samsung and Dell. Big, obviously, product distributors in India. We got their dealers onto the platform, and they could get financing. These dealers could get their inventory financed, but they could also access professional services. They could access other forms of financing. They could access each other. They could access their supply chain. And we've now got a thriving SME ecosystem with large companies having come in to supply that ecosystem. I think say 800,000 or something like that customers in a year or in India. We'll roll that out in Vietnam now with a different partner. We'll roll that out in Kenya and Ghana, but it's not our business.
Yeah.
The business was actually, in that case, was identifying the problem and the opportunity, and then creating a technology venture around it with the appropriate understanding of how regulation played into that.
I mean, it's interesting on that, and how much obviously the success you've had with SOLV, with Trust and Mox. I mean, how much momentum does that bring? You sort of de-risk the fear of this innovation through having been successful, because anybody I talk to is essentially trying to emulate the Mox, particularly the sort of success that you've had with that, because in a small market, in a very tough market to acquire customers, you've really done an amazing job to make that happen. Yeah,
no, it's been a great experience, and when I reflect back on Mox is our digital bank in Hong Kong. I guess we're up to 550,000 customers or something, which is it's a meaningful proportion of the bankable population in Hong Kong. We've got both a thriving deposit and payments product, but now also a credit product, and we're layering in now wealth management product. Targeted initially the younger digital native users and more mass market, but it's been an interesting dispersion of the client base into actually quite affluent people who just like the convenience. But I think the experience for us was it probably cost a little bit more as we did that same thing in Singapore with Trust, and we reused most of the tech stack, a fraction of the cost and a fraction of the time. Because we learned a lot of lessons. With the benefit of hindsight, we could have done things slightly differently with Mox, but this is part of the learning experience, and it's been extremely valuable for us. It also, I can tell you, it boosted the confidence of the organization that we can deliver it's a bank, it's a full-scale bank, that we can deliver a bank in a short period of time from scratch. This is not using Standard Chartered technology, and be quite successful at it. And I think it builds the confidence in the organization that a big bank can deliver very good tech. Obviously, the tech itself, and as we've seen in digital banks around the world, it's relatively easy to replicate what we've built technologically. So if you don't match it with the customer proposition, and you're not going to have a profitable business. You have a business, but not profitable. And I've been delighted to see that the customers of Mox, and now we've replicated that in Singapore with Trust, are extremely happy with the technical service that they're getting, but they're even happier with the underlying proposition. Which has a lot to do with the people that we've chosen to partner with.
Sure.
So in Trust Bank in Singapore, we partner with the FairPrice Group, which is actually part of the NTUC group. Now, FairPrice is the biggest grocery store chain in Singapore. About 50% of Singaporeans touch the FairPrice Group one way or another every day. And they also, in that group, distribute some fund management products, and they have an insurance company, and the overall sponsor is the Trade Union Congress, which is a powerful entity in Switzerland, in Singapore. The partnership's been extremely powerful in integrating the financial services proposition into really the lives of Singaporeans. The immediate mechanism is through reward points and promotions in the grocery stores, but it's more, as is the case with so many consumer-oriented tech platforms. It's about becoming a part of someone's life and becoming a very convenient, dare I say, lovable part of the life. And nobody loves their bank, but sometimes people do love their bank when it's easy. And if you can solve a particular financial problem or challenge quickly, you do love your bank. And if it's part of an ecosystem that you also love. So these are fantastic lessons for us, really. And we're trying to replicate that, not that particular business model, because it's any individual business model is not replicable in different markets, but just the lessons learned about what does convenience mean to customers? What is trust? Not to misuse the word, but what does it mean for a customer to trust their provider? Where's something a cross-sell, and where's something just part of the consumer's life, and that they expect things to be connected. We're learning tons of lessons. I think we probably have, I haven't counted lately, we probably have 40 partnerships across Asia, Middle East, and Africa, with telco providers, with other e-commerce platforms. We've embedded a banking as a service model with new tech into the largest e-commerce platform in Indonesia. Super fast growing. We're about to launch with the second largest e-commerce platform in Indonesia.
And how much is those partnerships? Because that's a different model in itself, right? And actually that requires a cultural shift of the organization to make those things happen, right? Because you're sort of releasing control a little bit there for distribution, and that. The emotional intelligence of an organization to allow that is a big step in itself.
Yeah, it's a really good point, and as I said before, we're not a huge global bank. We're a big mid-sized bank. And we don't have access to billions of individual customers. We could, through a massive marketing campaign and lots of branches and all that, but it's not economic to try to break into some of those markets where we have, in the mass market, have a very low market share. Typically, with the affluent population, we've got a high market share, but with the mass market, it oftentimes very low. And in India, 1%. In Indonesia, less than 1%. But we can access those customers with a differentiated proposition through partnerships. But a partnership it's a marriage, right? These aren't short-term. These aren't deals that you do. These are relationships that you form.
You don't procure them, right?
And if you base it on price or on a commission sharing, it won't last.
Sure.
It either won't be successful vis-a-vis the customer, or it won't last. So these are relationships that need to be built and cultivated. And so oftentimes we'll take a financial stake in our partner. I think we're yet to have a partner take a stake in us, but we'll take a stake in the partner, and maybe through at the point of an IPO or through a funding round, and but much more importantly, we'll establish personal relationships and a broader reaching business relationship than the specific whatever the specific offering is we're trying to create. And by doing that, we're learning from each other, and we're learning how to get on. We learn how to resolve disputes. We learn how to adjust to changes on the ground, either relative to what we understood or just a change in the environment or situation, and build trust. And that I think we become very good at. I don't think we had a lot of partnerships 6 years ago, and we have a lot of partnerships today.
Yeah.
And some of them came out of our SC Ventures unit. A lot of them came from our retail business or our corporate banking business, wholesale business, directly saying, we can accelerate what we want to do by giving up some control, giving up some economics, sometimes giving up complete control. And in some of the retail partnerships, we don't own the customer. Or the customer is owned by our partner. But we own the business, or we're running the business. It does require a fundamentally different mindset. I think we've struggled with it a bit, but we've had enough success that it's now embraced by the organization. If we're going to accelerate this, we're going to have to change the way we operate.
Yeah.
And we are, in fact.
And how much of that, again, I sort of come back to culture, because actually, that's the underpinning, the sort of the removal of friction that stops those types of things happening. How much of that, and I think I know the answer to this, but how much of that starts from the top, though? And then just as an anecdote, lovely guy in the reception this morning said, came in, we're like, hey, we're here to interview Bill, and he looked at me because I had t-shirt and a jeans and he was like, are you sure? And I was like, yeah, so. but he said,
sorry about that.
in the anecdote of coming upstairs, he said, you're the first person in, you're the last person out, you walk people out, you're a human person, you're not just the CEO of the organization. How much of the culture starts from the top?
Well, I think it's a necessary condition that my management team, our board of directors, are carrying the culture that we want to promote. It's a necessary condition. It's definitely not sufficient. It's not enough. And of course, every organization has a culture, and CEOs come and go. My anecdote of the guy who meets you in the reception. The first day I came into Standard Chartered after I was announced as the incoming CEO, the guy at the reception said, so who are you? His name was Peter. He's retired now. He'd been with the bank for 40 years. Who are you? I'm Bill Winters. Why are you here? Well, I'm the new CEO. Oh, yeah. He said, let me tell you, I've been here for 40 years. I think I've seen 8 or 9 of you guys come and go. I may see you go as well, but I wish you all the luck. Anyway, Peter became a very good friend, and I had lots of chats with him because he has a perspective. He loved the bank. He ended up working here for 46 years. And then he finally, I think at the age of 70, said, I think I've had enough. I'm not going to see you out. Right? But there is a culture. And of course, that culture come from me. That culture didn't come from me. That was the culture that was there, which the people that were here are very proud of the bank.
Yeah. And
through good times and bad, and we've had plenty of both. But we're also a bank, and we're also far flung. And I think if I asked my colleagues, 8 years ago, what do we really need to change here? That they might have said, we need to make it an easier place to get things done. And I'm afraid to say, if you ask my colleagues today, what do we need to change here? They'll still say, we need to make it easier to get things done. And that would be the case if you asked my colleagues in SC Ventures, where they might imagine that if they were sitting at Sequoia or something, it's much easier to get things done. I'm not sure that it is, but I don't know. I've never been there. But there is a culture of caution. Yeah. There's a culture of checks and balances, controls. We could blame regulators because regulators expect that kind of obstacle course for something that might be risky. But that's not really the regulator. It's supported by the regulator, but it's our own culture. So it's a real challenge. It's a real challenge.
It's an interesting balance there, though, isn't it? It's, I've worked at small companies where you can make things happen really quickly, but the impact of what you make happen is relatively small. Delivering capability that touches millions of people's lives is they're the types of things you look back on at the end of your career rather than, I've worked in management consultancy and I made some amazing PowerPoint presentations, but it's about the features that really touch people's lives that are really important, isn't it?
Yeah. And, everybody wants to move quickly. Everybody wants to be innovative and entrepreneurial and be ahead of the pack, and everybody wants to be successful. So, I mean, I've met very few people where I didn't think that we were aligned on all of that. And we have a pretty good idea what success is, in terms of financial outcomes, in terms of market presence, in terms of pride, and just feeling like you're doing the right thing, working for a good company. But somehow we still get in our way. And so there's a cultural obstacle where, I mean, I would love to stand up in front of, have a town hall meeting and say, we're going to become a super innovative culture safely and soundly. Now go do it. Right? Of course, I've said that about 1,000 times. It doesn't mean that anything changes in terms of the way people operate the next day. And so I think having a consistently articulated culture from the top is a necessary condition, but it's not sufficient.
Yeah, it's sort of an evolutionary thing rather than a revolutionary thing in that step, isn't it?
Yeah, and you need to change the rules, and you need to experiment with different incentive structures that incentivize people to behave safely and soundly, and at the same time to take risk and take decisions and be accountable for those decisions. You need to do that in a way that is appropriately respectful of the various matrices that we have. We have global lines of business. We also have countries. Those countries are in some cases not even 100% owned. So a number of our African countries, we own 90%, 92%. They have independent board of directors. They definitely have independent regulators who expect the local entity to be able to override what some instruction that's coming from London or Singapore.
Yeah.
And so there's a natural tension in the system that can really slow things down unless you find ways to work through it.
Yeah. So, I mean, we talked a lot about where we've come from. Maybe touch on where do you think the industry is going to go? We talked about partnerships. We talked about technology change. Where do you think we'll be 8 years from now? Because the momentum in all of these dynamics is really significant.
Yeah, I think the basic needs of customers aren't changing. They need to transact in financial markets for their daily living. They need to protect their wealth and grow their wealth to the extent that they've got it. Corporations need to have facilitation for their trade, for their sales, for their purchases. Financial risks aren't going away, so they will need to manage those risks regularly. So the challenges for customers will be the same or greater. Of course, things are shifting, so the geopolitical challenges around the world, trade patterns, the trade behaviors, nationalism, I mean, these things are changing the way that corporations operate. Our job has always been to connect people and to help them manage their connections in a profitable, prosperous, safe and sound way, right? And that's not going to change. So there are some things. Regulation is a factor in our lives. There are some things that are very difficult for banks to do. So, for example, it's been very difficult for a bank to be very active in the cryptocurrency world because the bank capital rules make that very penal to do so. My argument with the regulators, I've been quite public about it, is you should be begging us to get involved in digital assets. One, because it's going to be an important part of the future of the financial system, and if you don't want that to be outside of the banking sector, then you have to let us in. Second is we can bring a perspective to you that you can't get anywhere else.
Sure.
Right? And how long would it have taken Standard Chartered Bank or another bank to realize that FTX was a scam? 10 minutes?
Yeah.
Right about the time we said, can we meet your head of compliance? That would have been the first clue.
Yeah.
But somehow it became almost systemic in the global financial infrastructure, despite, and I always say not just despite, because it was separated from the banking system. So regulation is impactful, but I think regulation changes over time, and with thoughtful engagement, we can shift that balance, and it is shifting now. Hence the creation of our Zodia custody and markets business, which is a custodian for digital assets and a market maker and exchange and marketplace for digital assets, owned by a bank with partners. So I think we will continue to evolve in terms of the way that we can meet customer needs. I think banks that aren't continuously evolving, that aren't understanding technology that's coming, will disappear over time. And banks that are on top of that game don't have to be the most innovative, because we have other natural advantages. We have a trust advantage. We are regulated. That actually is an advantage. By the way, it's also a protection. It's a protection if you need money in a rush. Banks, we have a lender of last resort. I hope never to use it, but it's there, and it's a huge barrier to entry for people that want to get into businesses that we do that are regulated. Most people don't want to be regulated if you can avoid it. So banks will be around. Banks that evolve and are at the cutting edge of addressing customer needs will thrive. Banks that don't will disappear. And non-banks will find ways to skim cream all the time, and that's good. When they skim enough cream, they'll either need to get into the regulated space, or they'll start consuming banks.
Yeah.
And that's also fine.
Yeah, it's going to be an interesting world to see how that plays out. As you say, the blurred lines between what is financial services becomes ever blurred, doesn't it? And I guess back to that point about partnerships, it's increasingly, who provides those services might not necessarily be the banks themselves, but...
Yeah, I mean, we all understand very well the power of a massive convenience platform and the power of the data that comes off those platforms. And, with the possible exception of a couple of the big Chinese e-commerce platforms, none have become full-throated regulated banks because they have a very big incentive to avoid that kind of regulation for the rest of their business.
Yeah.
But we know that in the absence of that regulatory obstacle, they could take over the world because they're just so convenient. Certainly for the mass market, where there's still some need for face-to-face interaction or human interaction, or particularly customized products or services, which is more the case in the corporate banking side. I think that's quite protected away from an e-commerce platform. But for the mass market, it would all be subsumed into a handful of big players, which I think over some period of time will raise concentration of economic power questions and monopoly pricing questions.
Yeah, the market always settles somewhere, doesn't it? But it's going to be fascinating to see. Maybe to close us out, Bill, then, I mean, maybe not just from the guy in the front door's advice, but you've had a great career here, but of other organisations as well. I'm sure you've been given lots of advice sort of getting into the industry and through your career. What's the big piece of advice that sort of sticks out for you of that you've tried to maybe live your life by?
My favorite piece of advice came from Yogi Berra, the famous baseball manager in the U.S. He said, "When you come to a fork in the road, take it." Really, it's when you come to a fork in the road and you've got the choice between the established safe path and something that feels a bit wacky. Just at least 3 times out of 5, take the wacky path. You'll either learn a really valuable lesson the hard way, or you'll find yourself in a wonderful position because you've got lucky. And I've had just a handful of times in my life when I was at one of those forks when I had a choice. You don't always have a choice, but sometimes you do have a choice. I had a choice to come to Standard Chartered. It wasn't the obvious choice that a lot of people would have expected somebody who had done what I had done up to that point would have done. For me, it was perfectly obvious. It was a fantastic bank that had fallen on hard times for reasons that could be fixed, in my assessment. As I've now spent time here, we have fixed those problems, and it will be one of the most rewarding episodes of my professional life. And that's, but it wasn't conventional, and it wasn't conventional for the bank to hire me either. Just as an aside, I think there was an alignment there. So my advice would be take the wacky path from time to time.
Very good. I like that. If you sort of want the outcome everybody else gets, then do what everybody else does. If you want to do something different, right? It's a good one to live by, but I'm going to go look for my wacky path, I think, after this. But
I'm guessing you found it.
Probably. That's probably very true. All right, on that note, we're going to have to wrap up, though. I know we've all got things to go and do, but Bill, thank you so much for joining us today. Where can people learn a little bit more about Standard Chartered? And I mean, you're pretty active on LinkedIn as well, right?
Yeah, I've got a LinkedIn account. I get a few followers from time to time. SC.com, good place to get the big picture, or come visit us in one of our branches around the world, or come work for us.
Very good, very good. Thank you very much. That's all the time we have for today, though. If you want to catch up on this episode, but every other episode as well, head over to YouTube. You can follow 11FS or Fintech Insider on pretty much every social media channel at this stage. But that's all the time we've got for you today. Thank you very much. Goodbye.